My name is Fernando Duarte, and I'm a research economist in financial markets here at the New York Fed. The title of my presentation is A Framework for Financial Stability Monitoring. We proposed a matrix approach where you have two dimensions. One dimension looks at different sectors of the economy, asset markets, the banking sector, the shadow banking sector, and the non-financial sector, and four different vulnerabilities that could potentially lead to systemic risk. And these were asset valuations, like the pricing of risk, leverage, maturity and liquidity transformation, and the connectedness and complexity of financial markets. Number one, that after the financial crisis, we realized macro, prudential policies and systemic risk are a really important part in terms of financial regulation and monitoring. The second one is that we now have a good framework to think about these issues, and that was not the case even 2-3 years ago. And the last one is that this framework tells us that we should be looking at the vulnerabilities of the system and not necessarily try to predict when the bad events or the negative shocks are going to happen. A metaphor for the way we look at systemic risk in the financial system is an earthquake. So it is very difficult to predict when an earthquake is going to happen, and it is also very difficult to predict how strong the earthquake is going to be. Maybe we have a good sense of where geographically they might happen, but that's also not a very clear boundary. On the other hand, we do know how to build strong buildings that have a strong foundation that will be much more robust when the earthquake does occur. So here the analogy is that the earthquake is the shock, the negative financial event that starts the whole systemic risk chain, and the vulnerability is how strong the buildings are. So if you have a very strong building that's going to be not so vulnerable, then the economy is going to be okay. Then we can keep the analogy going further, and we can say, well, if one building is weak, but the other ones are strong, then that also prevents contagion, which is something we can make a comparison to with financial externality. So if one building falls on top of the other, is the other building also going to fall? Or is it strong enough? Is it robust enough? Does it have the vulnerabilities figured out so that it won't fall as a reaction of the first one falling?